Today, the European Central Bank has left interest rates unchanged at 1%. It has adopted a wait-and-see mode after recent economic reports suggested that the Eurozone may be over the worst of a winter downturn. Attention is now going to shift back to whether the bank is ready to help Greece avoid a messy default. The ECB President Mario Draghi, addressing a press conference in Frankfurt after the Governing Council met, as mentioned earlier, they have left the key lending rate untouched at 1%, and going by Draghi's comments on inflation remaining at elevated levels of above 2% for the next several months, you could possibly assume that the 1% rate may not be tinkered with for some time at least. On the more pressing issue of whether or not the European Central Bank will participate in a restructuring of Greek debt, he's avoided that question clearly. The one big thing he's acknowledged, though, is the fact that the LTRO, which was announced in December, hasn't exactly worked in terms of easing the credit crunch that is being witnessed across the European Union at present. He has said that they are monitoring the situation and that some sort of decisive action on that front will be taken over the course of the next few months, as and when, based on the feedback they get from banks that will be sort of extending credit into the markets. Across to Frankfurt then, where the ECB chief, Mario Draghi, is addressing a press conference.
Since the first 3-year longer-term refinancing operation was conducted in December 2011, we have approved specific national eligibility criteria and risk control measures for the temporary acceptance in a number of countries of additional credit claims as collateral in Eurosystem credit operations, which credit claims should lead to an increase in available collateral. Further details will be provided in a press release to be published today at 3:30 p.m. At the start of the current reserve maintenance period on January 18, 2012, the reserve ratio was reduced, freeing up additional collateral. As stated on previous occasions, all our non-standard measures are temporary in nature. Let me now explain our assessment in greater detail, starting with the economic analysis. Real GDP growth in the fourth quarter 2011 is likely to have been very weak. According to the survey data for the last 2 months, there are tentative signs of a stabilization in economic activity at low level. Looking ahead, we expect the euro area economy to recover very gradually in the course of 2012. The very low short-term interest rates and all the measures taken to foster the proper functioning of the euro area financial sector are lending support to the euro area economy. Moreover, stress in financial markets has diminished in response to our monetary policy measures, but also in response to the progress made towards a stronger euro area governance framework and to the intensified fiscal consolidation in several euro area countries. However, subdued global demand growth, the remaining tensions in euro area sovereign debt markets and their impact on credit conditions, as well as the process of balance sheet adjustment in the financial and non-financial sectors, continue to dampen the underlying growth momentum. As I said, this outlook is subject to downside risks. They notably relate to tensions in euro area debt markets and their potential spillover to the euro area real economy. Downside risks also relate to possible adverse developments in the global economy, higher than assumed increases in commodity prices, protectionist pressures, and the potential for a disorderly correction of global imbalances. Euro area annual HICP inflation was 2.7% in January 2012, according to Eurostat's flash estimate, and was unchanged from December. The average inflation rate for 2011 was 2.7%, mainly driven by higher energy and other commodity prices. Looking ahead, inflation is likely to stay above 2% for several months to come, before declining to below 2%. This pattern reflects the expectation that in an environment of weak growth in the euro area and globally, underlying price pressures in euro area should remain limited. Risks to the medium-term outlook for price developments remain broadly balanced. On the upside, they relate to higher than assumed increases in indirect taxes and administered prices, as well as increases in commodity prices. The main downside risks relate to the impact of weaker than expected growth in the euro area and globally. The monetary analysis indicates that the underlying pace of monetary expansion remains subdued. The annual growth rate of M3 decreased to 1.6% in December 2011 after 2% in November, reflecting a further weakening of monetary dynamics towards the end of the year. The annual growth rates of loans to non-financial corporations and loans to households, adjusted for loan sales and securitization, also decreased further in December and stood at 1.2% and 1.9%, 1.2% to non-financial corporations and 1.9% to households. The volume of MFI loans to both sectors declined in December, and this was particularly pronounced in the case of non-financial corporate sector. In addition, there are indications that bank lending conditions tightened further, affecting loan supply in several euro area countries in late 2011. It's not yet possible to draw firm conclusions from these developments, particularly given that the impact of the first 3-year LTRO on bank funding is still unfolding and may not have been fully reflected in the most recent bank lending survey. In addition, other non-standard monetary policy measures announced in December are still to be implemented. Accordingly, close scrutiny of credit developments in the period ahead is essential. The soundness of bank balance sheets will be a key factor in facilitating an appropriate provision of credit to the economy over time. It is essential that the implementation of banks' recapitalization plans does not result in developments that are detrimental to the financing of economic activity in the euro area. To sum up, the economic analysis indicates that the underlying price pressures should remain limited and risks to the medium-term outlook for price developments remain broadly balanced. A cross-check with the signals from the monetary analysis confirms this picture. A combination of structural reforms and fiscal discipline is essential for boosting confidence and delivering a favorable environment for sustainable growth. Regarding fiscal policies, all euro area governments need to continue to do their utmost to ensure fiscal sustainability. It is essential that all countries adhere to the fiscal targets they announced for 2012. This should help to anchor expectations of sound fiscal policies and strengthen confidence. The rules guiding the design and implementation of national fiscal policies are being strengthened at the EU level, as well as in the legal frameworks of several member states. These are important steps in the right direction. With regard to structural reforms, these are key to increasing the adjustment capacity and competitiveness of euro area countries, thereby strengthening growth prospects and job creation. Notably, far-reaching and ambitious reforms should be implemented to foster competition in product markets, particularly in the service sectors, while rigidities in the labor markets should be reduced and wage flexibility should be enhanced. I'm now at your disposal for questions.
Okay, just a reminder, We will take one or two questions per media, no more. And please, will you be kind enough to present yourself and say to the media you belong to, and also to stand up so that the President, the Vice President can see you better. Thank you. First question, yes, on the block one, yeah.
I'm Alessandro Merli of Il Sole 24 Ore from Italy. Could you clarify the position of the ECB with regard to the Greek bonds that you hold at in various forms from the S&P and also the investment? And would it be feasible for you to deliver them to the FSF and get the FSF bonds in exchange? Also, with the national central banks now setting...
Go ahead.
The national central banks now setting criteria for the acceptance of credit claims. Is there a risk of fragmentation of the financial markets in Europe, which is already apparent in the repatriation of a lot of the lending activities?
Now, on Greece, I'm sorry to say I cannot say anything about how our holdings of Greek bonds, both under the S&P program and under national central banks AMFA holdings, will be treated. What I can say, however, is something that a few minutes ago I got a call from the Prime Minister of Greece saying that an agreement has been reached and has been endorsed by the major parties. This afternoon we'll be having a Eurogroup meeting with the ministers, and we will be having a full report of the agreement and also a discussion of the further steps. On the second point, let me say this. With the first 3-year LTRO, we avoided a major credit crunch. I've already said there were 230 billion euros of bank bonds coming due in the first quarter. And as you saw from the things that I've just read in the press communique, credit has been tightening already in the last 2 quarters of last year. It started and then it progressively accelerated its tightening, especially in some countries like Italy and Spain. Once we've done that, we've also asked ourselves, how can we make sure that this facility could reach not only the large banks that usually have plenty of collateral and packaged in a way that reflects our normal eligibility criteria, but also should reach the small and medium-sized banks that are most important to finance the SMEs. And usually their collateral doesn't come in a way that naturally fits our criteria. So that's why we extended the eligibility criteria for this collateral. The big question that I saw in at least one article is, but this is going to be very risky. Sure, it's going to be more risky. Does it mean that we take more risk? Yes, it means we take more risk. Does it mean this risk is being unmanaged? No, it's being managed. And it's going to be managed very well, because there will be a strong over-collateralization for these additional credit claims. The conditions will be very stringent. Each NCB, each national central bank will assess these credit claims on the basis of common guidelines, common rules, and the various NCB proposals will be evaluated by the Governing Council. So we will be reviewing the situation in 6 months' time, but we feel like if we have taken risks Incidentally, by the way, it's not all bad, because this will increase the differentiation of the sort of collateral we have in this facility. But in any event, we will review the situation in 6 months' time. So, if we have taken more risk, we also made sure that this is going to be very, very well managed. And the purpose, as I said, is to finance the real economy, and especially, I would say, the SMEs, which count for almost 80% of the employment in the euro area sector.
Okay, thank you. Block 2, first row, Silvia Vada, please.
Silvia Wagner from CNBC. Mr. Draghi, how exasperated or maybe concerned are you by the fact that we do have a problem with lending? I think a recent study from one of the major banks came out and said only 7% of the lending is being passed on to the so-called real economy. You said it's a bit early to say whether all the measures have landed yet, but how concerned are you that we're indeed heading into a credit crunch at a critical time for the Eurozone economies? And the other question, I think somebody has to ask it, what's the latest stance of the ECB on potentially taking famous haircuts on bonds to Greece or possibly other countries, but we're talking about Greece at the moment?
Well, the second question I really, in a sense, didn't answer before, so I continue not answering really. But on the first question, I'm sorry? But on the first question, we are indeed concerned by this slowing down in credit. I said we have to wait because part of it had to do with the funding pressures that banks anticipated for the first quarter of this year and that we have removed with our 3-year ELTRO. Part of it had to do with the capital requirements that they were expecting following the EBA stress tests. But part of the reasons had to do with risk aversion. Now, our sense. Now, let me say also another thing, that the data we have in the data I just gave you from the bank lending survey don't fully reflect the coming into place of the LTRO, because the bank lending survey was run just in the middle of that period. So we'll have to see exactly two things now. We have to give a little time to see whether these things are moving for the better. We also have a second LTRO. So let's not forget that some banks use these proceeds, the borrowing from the LTRO, to refund their own bonds. So in this sense, it was not new fresh money available for lending. But as I said many times, these operations address the liquidity risk, not the lack of capital. To some extent, they address the risk aversion, to the extent the risk aversion depends on the perceived lack of liquidity of your counterparty.